So it's a right to buy. It's basically just a contract, and it's a right to buy or a right to sell, and that's what you're trading. Or you're holding to get a position in a particular equity or in the futures. And so what these really are is kind of like insurance policies. There's ways to basically hedge positions. So when you see this elevated put-call ratio, and it's not super high, when it gets to 1 standard deviation above or 1, when it's over 1, there's more puts to calls. When it's below 1, there's more calls to puts. So I'm going to look at the VIX in just a minute. VIX is more of a direct fear index, whereas the put-call ratio is just telling you kind of a sentiment. So what you see here is a bullish market with a sentiment of we're kind of bullish too, but we want some protection to the downside just in case there's a hiccup. And that's what I'm seeing here. But in general, what do I see? I see upside potential. Here's the VIX. Now, the VIX is basically a measure of the overall market volatility. And you have the red line being the VIX, and these are 5-day moving averages of these lines, by the way, they're average out. And here's the S&P 500. You can see as the VIX has come down, 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 down from the beginning of October, the S&P has totally climbed. Now, one thing about the VIX is -1 standard deviation. That's an extreme. Typically, when you see this, you expect a market correction. However, given the time of the year, and given that these fund managers and the big brokers want to get their bonuses, and the Fed keeps on increasing you're probably not going to see that correction until next year. So knowing about the seasonality of the market right now, knowing about what the put-call ratio is saying and what the VIX is saying, that tells me I have to have a bullish perspective. Until proven otherwise, I have to be bullish. Now, that doesn't mean I have to jump right in. That means I can wait for a pullback. We've had a couple of pullbacks, as you can see, with these downward spikes over the month of November. And each one of these pullbacks could have been an initiation of a long. So again, there's some protective puts going in. And by the way, when you see that somewhat elevated put-call ratio, it also tells me that I have to think likewise. Any trade I take, I have to be aware of putting some hedge or protection on. And that's one of the beauty of options. And we'll talk about some trades, and every trade I talk about here will have a hedge on it. So we need to think like the big guys think, okay? We need to think just like them. Now, some people, and I love Tom Sosnoff at Tasty Trade, is one of my friends, and you know, he and many big traders like him are just camping at the bit, using a horse analogy, to short these markets. But in this case, I don't want to be like Tom, because I think he's right, and I think it's probably going to happen in 2014. But right now, I want to be like Mike. I want to be like Blue. I want to go with the market direction. I know what I might think. I know what the future may hold, but I've got to see what the data is telling me right now. And right now, the data is telling me that this is a bullish market, and it probably will continue with the liquidity that's going on. That being said, let's look at the mini chart to last night, and this is a daily chart. I took it last night, and you can see it's very, very bullish. Again, the pullbacks are great opportunities to go long, and if you want to see my moving averages, they're right there. You can look at this with your time. These are the moving averages I like to look at, and I'll tell you more toward the end here and give you an opportunity to spend a little bit more time with me. But here's the support line. I drew that in. These are all moving averages. Essentially, we came back down to that trend line, and we've been bullish all along, and here's the 200-day is the red line. What we're seeing is a bullish market. I mean, we've pretty much been bullish from way, way back, but you can see we've been kind of with nice pullbacks all the way and really been bullish into the fall and very strongly, and we've had a lot of Fed power to that. So again, we looked at the S&P and the put-call ratio and the VIX. All those things say, you know, you might want to still stay long but have protection. And again, I see the same thing here, kind of a bullish pattern. You know, I like to catch these pullbacks. So this happened about 3 days ago. So whenever you see these pullbacks, and that's the 20 or the 20 simple moving average and the 13 exponential movement, those are great entry points on anything, not just the market, but the stocks. Now, we're losing a little momentum, as I can see down here, a little bit of momentum being lost, but still we're upward trending. And in fact, I think great opportunities possibly for a pullback right after Thanksgiving to enter back in again. Dow, same thing with the Dow futures. That was the E-mini futures. The S&P futures is the Dow. Same kind of pattern. a kind of more of a sideways pattern on the E-mini, but then bullish and a breakthrough right here toward end of October, beginning of November. So really the markets are performing the way they're supposed to perform this time of year, are supposed to perform as they typically perform this time of year. So again, we're seeing multiple markets, and I'm going to go through these two, that are looking at bullish. Now let's look at some historical performance of the SPY. Here's an analysis. It's from one of my friends, Virgil, a spreadsheet he put together, and it just goes back and grabs history. And what you can see is that since 2006, between today and the 24th of December, there's a positive move in the S&P or the SPY. So that's the SPY's holiday performance. So we not only look at charts that are looking bullish, but we're also looking at historical performance. Now, prior to that, there were some bad years and good years. In 2002, and a lot of you know about 2002, that was a bad year. Even 2008, with everything that was going on, we still had positive performance this time of the year. And if you actually look all the way down that row, you will see that net over all those years, there's still positive performance. And that's what we have to think about. So that's actually looking at the history. And one of the things that you like to do is look at the present chart. One of my buddies, Chuck Crow, he's a master of numbers. He always likes to look at opens and what the market's done before and the numbers that are doing now. So to me, I look at what the market's doing now and then also look at what the market's historically done. Here's the DIA or the Dow, similar type of performance. So either of these indices could be good bullish indices or good bullish trade indicators going into the holiday. Now, will there be some pullback? Sure they are. We're at a very high top. That's why those put protections were in. There could be some pullbacks, but all in all, this market is a bullish market. So looking at that tells me I have to think from the long side. I cannot be biased. I have to think from the long side. So given that, on the second day of Christmas, Blue gives to you a holiday trading plan. So I'm going to give you some of a plan. Remember, we always like to plan our trades and trade our plans. And what I'm going to do is give you a generalized plan, and I'm going to give you some specific things to look at. But this is kind of a good generalized trading plan to help you through the next 30 days. So let's look at that. Here's what I'm looking at. If the market's over 1789, I want to consider bullish trades. Notice we are over 1789. In fact, we crossed that last week. And actually, one of my friends, Tom Busby, was talking about that as well. We're all looking at these numbers. And by the way, we always look at numbers. What's a key number? What would indicate a pretty strong bullish side perspective? So we want to consider bullish trades as long as we're over 1789. Now, if we're below 1789, it doesn't mean I'm going to run around shorting the market. That could be a pullback, and I might want to still consider going long when it crosses back above that again. All right, now the other thing I want to do is I want to think about what kind of strategy am I going to use for my trading. So in other words, what strategy, oops, did something wrong there. I was trying to get my cursor and I think I messed it up. Sorry about that, guys. Give me 1 second. I think I hit the wrong button. All right, at least I got a little arrow here that you can see. All right, so you want to determine the market strength to decide strategy. Okay, so let's talk about that a little bit. If this market starts chopping up here, let's say it's above and below and above and below and right around that 1800 number, think about credit spreads, and I'll talk about this in a few minutes. Consider credit spreads. That's a good way to go in. All right, so that way you're not fully committing, you have a hedge to the other side, and there's actually ways to protect these that I'll talk about in a bit. If there's a weak dollar and a strong market, and this is what you're likely going to see for now, consider debit spreads. So if the dollar stays weak and the market stays strong, and not just for this month, but going forward, consider doing debit spreads. So right now we've got a bullish market. It could be a little toppy, so I might want to think about credit spreads. If we continue along the way they are and continue with the strength, I would consider debit spreads. In fact, my feeling is when you see a market like this, I would do credit spreads. Because if it pulls back, I won't be dumped out of my position, or I won't be stopped out of my position. I also can do a directional credit spread, and I can turn it into an iron condor to hedge it. So there's a number of things I can do as an option trader. As it pulls back on each of those pullbacks, I want to consider debit spreads because I'll make more dollar value move with that strong market on each pullback. So right now I'm thinking about credit spreads, although I'm going to give you a couple of variety of spreads. But again, if we maintain our strong market, then we consider debit spreads, and particularly on pullbacks. Now, what I recommend if you're thinking bullish, and I do both day trading with options and futures, and I do swinger position trading. So I would think about entering this week, entering Thanksgiving week, possibly putting a hedge in the week after that, or you can enter the week after Thanksgiving on a pullback and exit Christmas week. So you've got about a 30-day period with which to play these trades out. Another thing I would suggest is using diagonal call debit spreads. A diagonal spread basically is a spread across different strikes and across different months. And this is another way to play this a little bit longer term, possibly even going into January. So I'm going to talk about all these strategies a bit as we go forward. Now, the other thing I recommend is think about sizing in and sizing out. Enter and exit using half sizes. Now, because of my busy schedule, I'm going to probably exit with full sizes, and then I'll hedge as I need to. So to begin and end these trades, think about sizing in and sizing out. Definitely sizing out if you go all in like I might go. Then you can size out. Now, one of the reasons why I say half sizes is we could enter this week, and technically next week the market could have a pullback. Well, that's a great entry. That's a great opportunity to add to your trade as long as we don't break support lines in the E-mini or the Dow. Okay. So, and again, I will have a list of slides. And Morgan, I'm getting a message from one of the students that they say, or one of the attendees, saying that they're, I guess they've put in the link, but they're not. They're entered but not registered, or something, or registered but waiting for an invitation. That's what it is. I don't know what that means. But they say they're registered and waiting for an invitation, so I don't know how they do that. If you tell me, I'll kind of send them an IM back. So basically, we want to constantly, when we're doing this, think about what the market's doing in quarter numbers. That's part of our trading plan. That's why I say market above 1789. Think about how the market's looking strength-wise and directional-wise to consider the type of option trade we're doing. Think about, because of that bullish pattern we see on the SPY and the Dow through the, or S&P and the Dow through December, think about entering this week or even next week and exiting Christmas. Think about doing both debit and credit spreads. And again, sizing is very important. It's a good part of risk management. So you can go 1/2 of the position and then add to that position. A lot of times this week can be so strong that after today you get a pullback and then this powers forward. And I can get in and get out of half my position very quickly. There is a, Edwin, there is if you scroll up, there's a list of all the speakers. And if you guys, and Morgan, if you want to project that again for them, you might want to do that in the general announcements so they know what the schedule is for today. But there is a schedule, Edwin, and Morgan will be glad to post it for you. Excuse me. And all these presentations will be recorded for your later edification. But we're starting with the best first. On the third day of Christmas, Blue gives to you a bullish option strategy. So let's talk about a bullish option strategy. All right. So it's a vertical bull put credit spread, and these are the types of spreads I'm looking at right now. Basically, you buy an out of the money put and you short sell an out of the money put. Now, if you want a little bit more of a momentum trade, you can buy an out a slightly at the money put. I'm sorry, buy an out of the money put and short sell a slightly at the money put. I'm not going to do that because I'm not going to be here to watch this. We got holidays going on. I'll be seeing clients on Friday, possibly trading Friday morning. I'm not going to have as much focus on the market this week as I might other weeks. So I'm going to do both out of the money options. And that is safe. That's actually considering risk, and it's also considering putting in a hedge there. Now, you can go 1 to 3 months out on these types of trades, depending on whether you want it to be a longer term trade or a shorter term swing type trade. Now, I'm going to be 1 month out for the holiday. So because we have a holiday period, I'm only going to be 1 month out. So if I'm shorting these things, I'm shorting to December's. Now, that doesn't mean that you can't do, folks. If you're sitting there all day long and you have the time, I don't, you could actually convert some of the things I'm going to show you to weeklies, and there's no problem with that. I'm showing you the thing I'm planning on doing and the strategy I'm using and the month of expiration that I'm using, but feel free to use weeklies on these credit spreads if you want to. On the debit spreads, I don't recommend that unless it's a day trade, but I'm trying to give some trades that are more holiday trades, not this in and out. It's going to be crazy enough with Christmas and having to get things ready than sit in front of a monitor and hold on to a mouse. My preference over the holiday is kind of enjoy some of the holiday and not to be focused on the market every day. All right, also using an equal number of contracts. 5 on one side, use 5 on the other side. 10 on one side, 10 on the other side. The other thing is try to bring in a decent credit. So 40 cents is the net credit, the lowest net credit you want to bring in, and we'll look at some real examples of this that I'm looking at. But the minimum credit should be 40 cents. So if I'm using a 10 lot or 10 contracts, that's bringing in a minimum of $400 on these trades. Also, we'll talk about at the end, we'll be talking about that as well, the adjustments. Again, my net delta, when you take these kind of spread trades, you take the delta from one position, you take the delta from another position, and then you subtract one from the other and you get the net delta. And yes, this is being recorded, folks. This is being recorded, and I also have a PDF for you, JS, so don't worry. I'll have that for you. And then also exits. We can exit on expiration with these. We can exit at 40 or 50% of a return or loss on risk. So that just means if I'm up 50% or down 50%, I need to consider either exiting this trade and taking profit or taking the loss or doing some type of hedge, and also 1/2 the time. Sometimes if you get into these trades and they're just not working out, we'll talk about time decay in a few minutes. Because of time decay on these credit spreads, I'll at least get some profit or my trading fees out and step away. So those are kind of my rules with vertical spreads. Now, on the 4th day of Christmas, Blue gives to you a bearish option strategy. I gave you a bullish one. It's only right to give you a bearish one. Now, it's basically the same strategy, but in this case, you're using calls instead of puts. Now, sometimes it's counterintuitive because you're thinking, well, calls are long or puts are short. Well, when you short calls, then you're long. When you short puts, then when you short calls, you're short. When you short puts, you're long. So it's just the exact opposite. And again, these are credit spreads. So we do the same thing. We buy an out of the money call and we short sell an out of the money call. Again, you can go from 1 to 3 months out. Sometimes you base that monthly perspective on how the volatility looks and around earnings. My criteria, typically I like to, in general, have a delta for that short side of 0.16. Although some of these are going to be slightly different. It depends on what I see the market doing, but my general rule is 0.16. Actually, to be honest with you, 0.16 is real conservative to 0.20. That's what I typically do. The minimum credit, again, the same number of contracts on each legs. And remember, because I'm going into the holiday, I'm only going to go 1 month out for these credit spreads. I will consider doing maybe more than 1 month, depending on the credits, etc. And sometimes I'll do shorter. Sometimes I'll do weeklies. In this case, because it's a holiday trading period, I'm doing the monthlies. And because I don't want to sit there all day long looking at the market. Minimum credit. So again, you want to bring at least a little bit of money on these trades. And again, your net delta, you want a 0.25 or better. So when you subtract one delta from the other, you want to have less than or equal to 0.25. So you want this to be too big. The bigger the net delta, the closer you are to at the money. And the closer you are to at the money, technically the greater the risk with these spreads. Okay, so and again, you can go back and look at these. I do want to get into some of the examples for you, but well, actually examples from either real trades setting up. And again, the same rule, expiration, 40, 50% return. If you make 50%, you can get out of these and move on. Sometimes it's worth it because of the margin. Or you can get out 1/2 the time. If these don't really play out and you're halfway through the trade, you're flat, or you're covering a little bit of your fees, or you're making a little profit, just get out and rethink the trade. Sometimes that can happen. Now, a lot of times with these trades, you can have kind of a sideways market and pull in the whole premium as well. All right, now I want to talk one thing about fundamentals. Basically, I tend to like to go to finviz.com, www.finviz.com, and that's a great place to do scanners there to look for these spreads. In fact, I had a course that I gave in Orlando about 2 or 3 years ago, I guess it's 3 years ago now, where I actually went through all those criteria. There's actually a whole protocol I go through, and it's actually a credit spread class I've given before. I haven't given it in a couple of years, but if people really have an interest, I don't mind doing that again. And it was well received. It goes for about 6 to 8 hours, depending on how many questions and how many examples or real trades we look at. But yeah, I have some real specific criteria which I can't go over right now. I'm going to show you some possible things directly here. Like I said, this is a gift, so if someone knows how to trade options, they may actually profit. In fact, I know they'll profit from this presentation. But I can't give recommendations for those who are educational. I'm just sharing what I do with you. What you do with that information is your choice. All right, option fundamentals. Basically, because these are contracts, because we're trading contracts, if you know anything about contract law, contracts typically have an expiration date. If you have term life insurance, it has an expiration date. If you put a contract to buy a house, that has an expiration date. If you have an insurance policy, that has an expiration date. Because of that, each one of these options has a premium or a price you pay for, just like you pay a premium for insurance. As time goes on, that premium erodes. So for example, if you buy homeowners insurance and you buy it for 12 months and you end up selling your house 6 to 7 or 8 months later, well, the insurance company will give you some of your premium back, but they're not going to give you all your premium back. Why? Because you bought that contract for a specific period of time. The premium basically refers to the risk. It's called risk premium. When you're paying something for to buy an option, that's what the broker-dealers want, because they're selling that contract to you. So the seller of a contract always incurs a risk. If you were selling a house when the market was in the height of its rally, and you sell the house, you run the risk of not making as much money. At the same time, you as the buyer, there could be some risk if the market dropped down, but the bottom line is, as the buyer, you can just walk with just a loss of your deposit. Whereas with the seller, you could have lost the sale because that option contract has a certain period of time. Oftentimes houses are 90 days, the contracts to buy are 90 days. So all these contracts, all contract value that gets eroded over time, and volatility plays a role in this, is called the extrinsic value. Okay, so there's an intrinsic value, that's the amount by which the option is in the money, and the extrinsic value is the amount of time decay or volatility. Now this will really accelerate in the last 90 days prior to expiration, and that's why typically you want to do these 1 to 3 months out. It's www.finviz, Finviz.com, Finviz.com. Okay, www.finviz, there you go. Thank you, LW. And I do some other things too there. It's more detailed. But that's a good place to start to look for scanning. I also look for stocks that have high volatility, and I'm expecting a drop in volatility because volatility gives you more premium. I also look to do these right after earnings occurs, as the volatility is dropping, right after a high period of volatility. Those are all good times to look. So really, a short period of time before the expiration with high volatility is a beautiful criteria to use for these. And you can look at betas and such through that Finviz website. Now here's just a plot of the time decay, and you can see, or that theta value or time decay value, and you see how it really drops the last 30 days, and particularly the last 90 days it drops, but the last 30 days really drops. So when you're doing these credit spreads, if the market didn't even move, you would still bring in your premium because that contract expires worthless, and that's why you use out-of-the-money options. As long as you use out-of-the-money options, guess what? That whole value, those options are basically worthless. So you're selling an option that basically is worthless with the hope of keeping that whole premium. You're like the insurance company selling an insurance policy to someone when there's a low-risk period of time and you're bringing all the money in. In fact, let's be honest. Who makes more of the money? You or I buying our insurance policy, or in toto, who makes the money? Us or the insurance companies? Same with the brokers. Who's making more of the money? You or the brokerage companies? So we want to think like the brokerage companies. We want to think like the insurance companies. And that's the value of these credit spreads. Now we're going to talk about some debit spreads too, because I like them. As I said, it depends on the market conditions, and you can go back and look at that slide. But we have to keep in mind theta or time decay when we're doing these, because with credit spreads, it's in our favor. With debit spreads, we got to keep it in mind. Or if we're just going long an option, we got to keep time decay in mind. Because if the option is out of the money, come expiration, it will be completely worthless. That's why we like to sell it. Okay, on the 5th day of Christmas, I'm not a good singer, so I'm not singing this to you guys. And I didn't have a link to music, otherwise I would have played the 12 days of Christmas music as we were starting into here. So on the 5th day of Christmas, Blue gives to you a bullish market credit spread. All right, and let's look at that. So we looked at the DIA. We saw the DIA had a very, very bullish pattern in it. So we think, okay, what about doing a vertical bull put credit spread? And so what I am looking at, and again, this will vary a little bit because the market jumped up a little bit overnight from Friday to Sunday evening, and I would watch possibly for a little pullback today to take this trade. But basically, I would buy to open the December monthly 152 puts, and here's all the parameters. If you don't know how to read this, here's the instrument, DIA, that's the diamonds. 13 is a year. All right, that means the 2013. Here's 12, that means the month, that's December, of course, and 21 is the expiration date. And these are always on Saturday, but really you stop trading them at 3:15 Eastern time, I'm sorry, Central Time on Friday. And then this indicates that there's a put, so it means December 21st these expire. It's a put, and the strike price is 152, and that's how you read that. And BTO means buy to open, STO means sell to open. So I'm shorting a diamond contract and I'm buying a diamond contract. So I'm going to sell to open the 158 puts, and I'm going to buy to open the 152 puts. And I'm going to use 10 to 20 contracts on each leg, or each one of these I'll do 10 to 20 contracts. Remember I said you could size in, so I might start with 10 and then add another 10 to get to 20. So here's my credit. On the one I sell, I make $1.04. On the one I buy, I pay 30 cents, and that gives me a net credit of 74 cents. So if I have 10 contracts, there's a potential profit here of $740 less your fees. My net delta, if I take the delta on the one I sold and subtracted the one I bought, I get a net delta of 0.51. Now, as I said before, I like to use 0.16 to 0.20 on the shorted side. However, due to the bullish sentiment of the market and due to the fact that this is a very liquid contract, I'm violating some of my more longer-term swing trading rules. So if you've ever taken my course, a lot of times I like to look at 0.16 to 0.20 on these. This is a little bit richer, but I'm doing this on purpose because I see a real momentum play here. Okay, now, so we're going to sell this one. We're going to buy this one. We're going to bring in 74 cents or $740 if you got 10 contracts. And you could do all 20 if you wanted as well. If you did 10, you need $5 in margin minus 74 cents. If you did 20, then of course you need $10 in margin minus what's it, 158, no, 148, $1.48. Okay, and you can use your trade calculators to pick that up. Now, and you know, Harish, when you talk about that risk, I understand that a lot of people, because they're not really well depthed in options, don't understand that the risk is not $6,000. You think it is, but it's really not. If you understand how to trade these, number one, you're not going to risk the full $6,000, and that's only money put in margin. That's just set aside margin. You probably at the most would risk about $350 in this trade with trading fees. Okay, about $350. So you never take a whole loss on a position. And I understand if you're new to trading, sometimes those, and I'm glad you asked that because that's a good question. That is not the kind of risk. A lot of these, and you'll see as I go through here, I'm going to give you some of the, remember I said get out at 1/2 the risk. So if I'm bringing in 740, I might want to get out at a 350 loss, just so you know. So again, you're not risking as much of that. Okay, the net delta, as I said, and here I say you can exit on 36 cents debit or expiration. So if you held this to expiration, you could bring this full 740 in, assuming 10 contracts, or you could just get out on half. Now, this really reduces your risk. If you get into this and you take this position, and let's say this market just rallies over the next week or week and a half, you could easily take off half your position. And actually what I recommend, and you talked about risk management, Harash, what I recommend is move your trade to break even. So when you do these credit spreads, as soon as you take in half, move the the net debit that you're getting to break even. Now, I can't go into all this because this is not an options course. I did this for, like I said, this is my gift to options traders. It's a way, even if you're a newer option trader, this is a way to make money. I don't have time to go through all the risk management. If you'd like to do that, you can email me and I can send you a link to the courses that I do to teach that. I'm just trying to give a gift to those and give a little bit of general instruction. This is not considered a comprehensive options class. My class is about $1,000. It runs for 16 hours. It's best buy out there, and I'm not trying to sell my class today, by the way, but it's the best buy on options training that I've ever seen on the web, and per students it is. But in general, and I'm not trying to sell you anything today, so there's no sales slide at the end. I'm here to be totally to give a gift in education. But yes, I would take half off and then move to break even, and that's one of my risk management and exit trading rules. And how you place the stop is basically what I would do is I would say buy to close the 158 and sell to close the 152 at a net debit of 74, okay, plus 36. So if I added 36 to 74, that gives me what, $1.10? So I would say buy to close at $1.10, and that would be how I put in my stop. So if I wanted to put in a tight stop, that could be the stop I put in. So I'm not going to risk more than 36 cents on that trade. And again, that's really trade execution, but that's how you do it. And the same thing, if I wanted to put my target in, which I would put in right from the beginning, I would say buy to open the 158, sell to open, I'm sorry, buy to close the 158, sell to close the 152 at a net debit of 36 cents. And that's how you execute those types of trades. And that would be how you'd put it in once you got that entry on the trade. Many times these credit spreads will jump up and down. They'll go in your favor, they'll go against you, and guess what? The whole premium is brought in anyway. And I'm going to show you a little bit more advanced strategy to use with these at the very end on the 12th day of Christmas, so just give me a little bit of time. Good questions, though. Very, very good questions you're asking, and I'm covering a lot of them in the slides if you just hang with me. And again, I would recommend, because I'm going to give you the PDF on these slides, and Morgan very nicely gives us a copy of this. Just listen to it now, and then you can watch it again and really assimilate this more. And this is directly valuable. All right, on the 6th day of Christmas, blue gives you a mildly bullish diagonal spread. All right, this is diagonal call calendar spread. It's a mildly bullish strategy. You buy a long call option 2 months out, and you short sell a call option 1 month out. Now, typically, I'll go 3 months, and I'll go 1 month, but because we're in the holiday period, and that's why I have these in red, I'm doing 2 months on the long and 1 month on the short. Typically, if it's a standard scenario, this is more of a portfolio trade, I would do about 3 months out. But because it's the holiday, we don't want to go too far out because who knows what 2014 is going to hold, particularly at these lofty market levels. All right, so I'm going to buy a long call that's in the money. And right now, volatility is low, as you remember the VIX. So I want to buy the long call in a period of low volatility. And by the way, you don't have to short the front month call immediately. You can actually buy the long call, and then you can add in the short call if you want, if you feel the market's pulling back against you, and you're bringing more of a premium on the short call. Buy the long call, again, as I said, in a period of low volatility, and short sell a call enough strikes out for a net delta of greater than or equal to 0.25. So when you net out the deltas on the two positions, you want to be 0.25 or better. The short call value should have adequate premium. What I mean by this, don't do this for 5 cents. Don't short a call for 5 cents. Bring in what you think is reasonable. Probably even 10 cents isn't reasonable. You want about 30 cents out of these. So again, if you short one of these options, don't short it. Yeah, I do, Theo. And actually, I have a credit spread. That credit spread course I talked about, it does focus on weeklies as well. In my standard course, I do talk about weekly options. And again, that's kind of a longer thing. But by the way, you can apply the same strategy to weekly options. The principles are all the same. I'm just giving some specific trades that I'm looking at, because remember the title of this, it's Blue Horseshoe's Gift to Options Traders. So I'm giving a gift of my knowledge to you, and I'm giving a gift of some of my trades to you, or potential trades. These I'm looking at for this week. So I was actually setting them up last night. So I'm giving you this a mildly bullish diagonal spread. I'm going to buy to open the January 160 calls on the DIA. I'm going to sell to open the 164 calls on the DIA, and these are the Decembers. So I'm selling the Decembers, I'm buying the Januaries. I'm going to do 10 contracts on each leg. This is a debit spread. Now, calendar spreads are debit spreads versus the credit spreads. And remember the parameters I gave you in early on in here about which one to look at. If it's a choppy market, toppy market, do the credit spread. If it looks like we have a continuing bullish market, and it's not going to be super bullish over the next month or so. And that's why I'm looking at a calendar spread, because this is a mildly bullish strategy. You know, I don't expect the market to go to 1900 in the next month. I expect it to chop around at these levels and pull back and chop around. And that's where credit spreads are great. And that's also where these diagonal calendar spreads can help you. So I'm paying $5.58 for the long side, the 160s. I'm selling the short side, the 164s. I'm sorry, I'm buying the 164s. It's early morning. I'm drinking coffee, believe it or not, guys. I'm buying the 160 Januaries. I'm selling the 164s. The 164s are going for 31 cents, so I'm subtracting that out. The 160s that I buy are for $2.58. So my net cost is $2.21. Again, to get the delta, I just take the delta from the 164s, subtract the one from the the 160s, subtract the one for the 164s, and I get 35 cents. So that is my net delta, which is 35 cents. And make sure, and notice it meets my criteria that I set up. I'm a little bit more than 0.25 in these. So I'm meeting all the criteria. Now here's the target. The target is $3.50. And basically, very simply, this can move for about 3.5 points. And then once that short side goes in the money, I can either let it expire and they'll give me the net balance, or I can close out the trade for whatever the net is. And so this is 0.35 by 3.5. I think that's about what I got it. And I added it to this. So what I would do is I'd say buy to close the 164s, sell to close the 160s for a net credit of 350. That's not a bad take in 30 days, I don't think. So I would be closing this one out in December. So that would be the trade. So it's a diagonal counter spread. And again, you sell this shorted side. So if there's a little bit of pullback, you bring in a little premium, gives you a little hedge and protection, particularly with the market being at a high like this. You can track the delta changes in your options platform. Typically, things like Thinkorswim will actually show you the net deltas. Theo, you can trade Interactive Brokers or Garwood. Interactive Brokers, I believe, does support Australian clients, and I do use Interactive Brokers as well, particularly for my index trades and my futures trades, but you can trade options on it. It's not a bad package if you want to. And I actually keep that if I ever have to be international. I could trade anywhere in the world almost with that thing, as long as I have an internet connection. Yeah, there's certain rules with other countries. Okay, so that's one of the trades that I'm looking at. On the 7th day of Christmas, Blue gives you a North Pole money search. So we're going to search for money at the North Pole here. And here's Google. Google had a bullish gap, and now it's consolidating sideways. It's a high-level consolidation. Typically, a stock like this can break out. Now, this could actually be an iron condor type of trade if you want, but if the market does continue up, as it suggests it might be, excuse me, that's my phone quacking. Isn't it appropriate that a psychologist has his phone quack? Anyway, if you didn't get that, that was a quick thing there, if you heard the quacking from my phone. So basically, this is a bullish pattern. Okay, this is a bullish pattern. So what I'm looking at, and again, we're only doing this for a month. It's a Google vertical bull put credit spread. You buy the Google 995, you short the Google 1000 put. You can do 10 or 20 contracts at each leg. You can size in or size down however you want. The credit you bring in for the one you shorted is 685. The debit that you bring in is 580, and it's going to give you a net credit of $1.05. Excuse me. And your net delta, of course, you subtract out the two deltas, that's 0.30. Now, if you wanted to exit on 1/2, you exit at 0.52 debit, or you can exit at expiration and bring the whole thing in. If you look at the chart at Google, and you can take your time to go back and look at this, what you're going to see is you're going to see that Google, if it starts breaking below 1,000, it's breaking down. It'll go fill that gap. So it's a fairly safe trade. And again, I'll talk at the very end a little bit about hedging of any one of these positions, actually. There's a couple of ways you can do that. Dan, I had said that I use FinViz. I look at FinViz and I set certain parameters in for that. A lot of times when I'm doing credit spreads, I like to look at a little bit higher beta stock. Notice DIA is not a high beta, it's a lower beta, whereas Google is a higher beta. So typically what I'll do is I'll do a beta scan. I'll scan for beta in finviz.com, and I'll do a certain price range. It may be over 100 or it may be over 200, and I see what comes up, and then I look at the charts. And that's typically how I scan for these. I typically will also look at some of these same stocks like a Google or an Apple over and over again and just trade them over and over again. It's always good to learn a handful of stocks and just continue trading. Yeah, Doug Beal and I both trade with beanies on, long story, with a little propeller on them. If you ever see the movie The Interns with Vince Vaughn, you'll see at Google, I didn't even think about that, at Google you'll see that all the Google interns wear beanies with propellers. So Doug and I are in good company, or with crazy people, one or the other. All right, so on the 8th day of Christmas, Blue gives to you a golden bullish credit spread. So here is the gold miners ETF. So this is the ETF for the gold miners. Now you know that gold has been beaten up pretty badly, and we know that the dollar continues to devalue. At some point in the timeline, they've got to reduce liquidity. They've got to put the brakes on. Now, why they're not doing that right now is because we're essentially in the equivalent of a Great Depression. The economy is really bad. The government is doing things that are actually damaging the economy. This whole healthcare plan is very, very heavy on the economy. There's doctors closing their practices. People are losing their jobs. There's also increased costs that have been added in. The healthcare costs have been added in to you and I with no improvement in treatment and lower accessibility as individuals. All of this stuff adds to making the economy weaker. By the way, the only way we're going to get out of this is building more factories and building more infrastructure. And guess what? There's a little rule I have. In order to survive, you have to work. And you can't make an economy run by just playing with finances and playing shell games. You got to produce something. You got to produce something, even if it's Google search engines. If you ever not seen that movie, The Interns, it's great. You got to see it. And I'm blanking on the other guy, and I like him too, the blonde guy. Vince Vaughn is excellent. He's genius, actually. He actually is a genius. You know, scientifically, he is a genius if you measured his IQ. So back to my gold trade. So basically, instead of doing GLD directly, this is the gold miners. These are the suppliers. And as you can see, we pretty much have a double bottom on this chart. Pretty much a double bottom. So, and again, this is not a long-term trade. It's a shorter-term trade. So what I'm thinking about is selling to open the GDX December 22 put and buying to open the GDX 20 put. 10 to 20 contracts on each leg, depending on how much you want to hold. And this is going to be giving you a net credit of 59 cents. Okay, so 0.79 minus 0.20, the short one minus the long one. And my net delta is 0.29. Now this is a little bigger net delta than I typically use. I like a 0.25. Now I threw in a trade here that is, if some of you have an options experience, it's one that essentially has a potential of being put to you. So I'm much closer to the money. My delta is 0.44. It's just slightly out of the money on this trade. One of the reasons why I'm looking at this is I might want a position in these gold miners. So this has like multiple purposes. If it expires worthless, you bring in the premium. You can exit half at half the premium, which is 0.28, or you can exit the whole thing on a 0.28 debit, or you can hold it to expiration and keep in the full amount of money, or you can have, you know, 1,000 shares or 500, however you want. You can have it put to you at 22 cents if you feel that's a good purchase price. And basically, you're buying it at an effectively lower price. So if you have an interest in gold, this may be an interesting way. Now, why am I looking at gold miners versus gold? Number one, gold has a little bit further to go down if you look at the chart, number one. Number two, gold miners are actually real. This GDX is a group of gold mining stocks. Gold miners are not going to disappear. GLD is an ETF, and GLD really is not fully backed by gold. If you ever wanted to settle it out, they give you cash. They don't give you gold. It's not like gold futures. So, and if something happens within the economy or to the dollar, you could lose everything. At least I own shares of these gold miners. Okay, and gold miners are not going to go away. So that's why I kind of, now at this juncture, I'm looking more possibly to the gold miners than actual GLD at the present time. That does not mean I don't like the gold futures, because I do like the gold futures. And I know, Doug, that you are a bit of a gold bug. I remember your interest in this. So anyway, we've been very, very similar. Yes, Brian, similar trade, GDXJ, and that's just another ETF, a little bit more momentum in it. That's fine too. You'll probably, I haven't looked at that chart, but you might actually make a little bit more premium on that one, Brian, so you could think about that. So anyway, another potential trade. Doug's has gold at $300 an ounce. You don't really have to worry. I wouldn't even worry about, although you could do covered calls, Doug. All right, so on the 9th day of Christmas, Blue gives to you a free movie bullish credit spread. And of course, there's Netflix, play on words here. And you can see it's bullish too. Not quite as bullish as the other ones, but fairly bullish. So it's a Netflix bull put credit spread. And I'm showing some of these credit spreads because the market looks a little toppy, even though it's bullish. So you can bring in a premium even if this market doesn't go anywhere. A lot of times, the market goes up at this time of the year, but if you looked at those percentages, it doesn't go to the moon, because it's not like a rocket ship. These credit spreads may be a better play than the debit spreads on these individual issues. So in this case, I'm buying to open the 230 put. I'm selling to open. I'm sorry. I'm buying to open the 320. I'm selling to open the 325 put, and I've got 10 contracts in each leg. And again, my credit is $1.20. And my delta is 0.04, so I'm definitely below 0.25. And I can exit out on 50% of the premium. So let's say within the next 2 weeks, the Netflix goes up, and it goes up to, $3.75 or something like that. I can exit this trade, and I'm going to bring in at least 60 cents. Or I can hold it to expiration. Or I can take half off at 60 cents and bring myself back to break even. Okay, now break even is not entry, break even is break even. So in other words, if I'm bringing in 60 cents, I'm willing to risk that full 60 cents on these kind of trades. And it has to do with time decay and theta. If it's a debit spread, I'm not going to do that. I'm going to bring, actually, if you do a debit spread, I like to bring myself to to entry. So if I'm doing a debit spread, I'll move my stop to entry. With a credit spread, I move my stop to break even. And break even just means I'm willing to lose this full 60. Why do I do that? Because I find that I end up bringing in the whole premium when I do that. I don't want to leave. I don't want to miss some opportunities with this. I'm very, very risk management oriented, by the way, in all these trades, but I'll also show you some hedging. All right. So on the 10th day of Christmas, Blue gives to you a free bullish movie debit spread. All right, so here's another one just to give you a little bit of spice here, a little spice up the holiday. Netflix calendar spread, diagonal counter spread. I'm going to buy to open the January 350. I'm going to sell to open the December 375. 6 contracts on each legs. Notice the contract size has been decreased. Why? I'm doing that for risk management. This is a much more volatile stock. So therefore, I'm not going to quite risk as much because this thing can move 25 points in a very short period of time. If you want to know how far a stock moves, just look at the average true range or the ATR and you'll have it. Okay, so again, it's a debit spread. I buy the 350 for $19.75. I sell the 375 for $4.40. It's costing me $15.35. My net delta is 0.28, so we're meeting my criteria, 0.25 or better. I can exit. Now, this is my suggestion. Exit one half of that position, exit 3 contracts when your credit goes to 23.10, and then exit when the credit goes to 26.75. So I would recommend sizing out of this, okay? Not sizing in, but sizing out. This has more risk in it than the other trade, even though you wouldn't think it is. You'd say, oh, the credit spread is more. Well, actually, this does, because if this goes against you very rapidly, you could lose your premium. Again, what I would do is I'd keep a fairly tight stop on this, look at support and resistance. I don't have that here, but I would basically say, if you're, go back to the chart for a minute, you look at this 20-day moving average. If it starts breaking below that, you want to exit this trade because the black line is the 20-day moving average. You can see where that number is. I can't read it right there, but I wouldn't let this go too far against me. I would probably say on this one, no. If it's 50% against you, you got to totally get out of it. It starts going about 25% against you, and you start thinking about exiting this. Again, I wanted to give you a debit spread because some people like debit spreads, and this actually may be a good producer for you. Actually, this could be a good producer. All right. On the 11th day of Christmas, and in fact, this particular trade, as I look at it, let me get rid of this little pointer here for just a minute. I don't know if that's going to work or not. Is that working? Okay, it is working. Actually, I just thought about this, and this is a typo right here, and let me correct it right as I just shows you what happens when you're doing this stuff at 12 o'clock at night. Let me do this real quick for you because I just noticed a typo. Hang with me just 1 minute, folks. I just realized something, so I want to do it for you real quick. I just clicked on my brain. Slow as my brain may be. All right, give me 1 minute. I'll do it for you. I just noticed a typo. All right. And I don't want you to make a mistake if you do decide this trade. This is wrong. I based it on this net debit right here. It should be based on the 1535. So this is your first target. And let me give you your second target. So you're getting in at $15.75. You get half out at 13. And let me give the other one. Give me 1 second real quick. I'll calculate it there for you. And so this one's going to be 22.35. Okay, and I calculate those targets just by adding, multiplying 12 points and 25 points times this net delta and add it to my debit. So that's the credit and the debit. I just noticed that. So there's your two targets right there. I did proof the other ones, but I guess I was too tired to proof this one. So I'll catch anything to not get you in trouble. Again, if it went higher, that would be marvelous, but, you know, dream on. It won't go, you know, our luck, it wouldn't go that high. Anyway, so again, there's the calendar spread, and those are your two targets. And I would definitely take 3 off and take 3 more off and move my stop to entry, basically. So if I'm entering at 1535, then once it hits 1871, I bring the remaining 3 up to that 1535, and that would be my stop point. Okay. On the 11th day of Christmas, Blue gives to you a free books bullish credit spread. And here is Amazon, of course. You would know that that would relate it to books. And here, Amazon again looks bullish. You can wait for a pullback for these if you want. So an Amazon vertical bull put credit spread. I'm going to buy to open the 345 December. I'm going to sell to open the 350 put for December. You can use 10 or 20 contracts depending on how much margin you want to put aside. My net credit is 75 cents. My net delta is 4 cents. All right. So again, meeting all the criteria, we can exit with half profit. It's not quite half profit, a little bit less than that, 36-cent debit, or I can take half off at 36 cents and then move the whole trade to break even. Again, these are very, very high probability trades, or I can let the whole thing expire, or I can let the remaining half expire. So there's a lot of flexibility with how we can do these trades. So again, another one of these put credit spreads. Notice on these high beta stocks, I'm doing the more put spreads. Why? I'm not doing call credit spreads. Why? Because it's a bullish market. Why? Because they have high beta, higher volatility. And why? Because this market is getting toppy, so it could hit some resistance, and I don't want to go long right into resistance on the overall market. So these, I'm following my parameter and knowing it's a bullish market, but I'm using option trades that give me a little bit more protection. Now, there were some questions earlier, and this is going to kind of help add to that. On the 12th day of Christmas, Blue gives to you hedging strategies to avoid ending up with coal in your stocking. All right. Now, I have a whole hedging video that I did for Futures Mag, so I won't go into this in great detail, and maybe I'll do that here. I was going to do that today, but I thought about doing the holiday thing for Morgan in the future. I'll show you how to do these hedging trades, maybe in another Trader's Pub. So these are the hedges I can use. If I have, and again, I can just put my stops and targets in and leave it alone, but if I want to stay into it, let's say there's a little hiccup and I want to maintain it, then what I would do is I'd use long calls on a bear call credit spread and long puts on a vertical put credit spread as a short-term hedge. Okay, so let's say I'm in there and I said, look, I don't want to get out of this. I'm approaching my stop area, but I want to stay in, so I can put on a long call or a long put, depending on whether it's a put or a call credit spread. Now, what I like to do is look at the delta of the spread and use a delta equivalent or a larger delta. So when I look at that net delta, let's say it's 0.20, then the delta I would use on the long call or long put would be 0.20. So each time it goes against me, it's actually making money on my hedge side. By the way, when it goes back in my favor, I can close out that hedge and make some money. Again, our exits are break even, profiting on the hedge, or profit on the hedge and resumption of the trade. So I can exit this whole thing with the hedge on break even, or I could be flat the trade but profit on my hedge, or I can profit on my hedge and resume the trade. And I know I gave you a lot here. Please review the video. I want to thank you for coming. One other thing I want to tell you, Tuesday night, every Tuesday night I meet with my options group and I talk about trades and I talk about the market. If you would like to do this, email adam@dtitrader.com or dr.bluehorseshoe@yahoo.com and we'll invite you for free. I actually charge for the service. It's free to you if you want to hang in there with us Tuesday night. It's Tuesday at 5 Central Time, and we do record it, so if you can't make it, let Adam know, and he'll provide you with a recording. The other thing I want to tell you about, and this is something I've been working on, I'm doing an experiment, and the only thing you have to agree to is let me dissect your brain at the end of the experiment. No, I'm kidding. Don't panic. No, I'm doing an experiment, and I was hoping to do it in December, but there's been some family illness this year, and there may be some surgery going on in December, so I have to wait till January. All things going well, for the 30 days of the month of January, I'm planning on doing an experiment. It's an experiment in trading. It's using options and futures. I want to see if I can get students, and this is truly experimental, to be able to take trades along with me or follow what I'm doing and to profit equally. This is no charge for this. If you want to do this, and this is by hand selection only, email me at drbluehorseshoe@yahoo.com. If that bounces back, ask Adam, he'll give it to you. It's a special project I'm doing. You're invited for free. I do certain parameters that I'll show you some of that Tuesday night. There will be an introductory session, and for 1 month I'm going to do this experiment. One of the things I like to do is see if students can acquire the skills. So we will be doing trading. It is trading. I'll be out there trading and letting you watch, and you can follow along with me. It'll be very educational. If you know how to trade things like options or futures, you might make some money off of it. But I want to see if I can transfer that learning in a very short space of time, because we're all trying to educate and want to transfer it. If you want to do that, email me at the drbluehorseshoe@yahoo.com, and that will be in January, for the month of January. So thank you very much for being here and being patient with me. David, I'm sorry I didn't answer that question. I'm trying to run through this for Morgan. I'll try to answer that by typing in if I can. I'll try to type that in so I don't take up the next person's time. But I'll go ahead and I'll cut and paste that if I can, or I'll go back and answer it for you in the text. So thank you, Morgan. I'll roll over to the next person, and I don't want to run over their time. Everybody have a wonderful day. Have a wonderful holiday. It's dr.bluehorseshoe@yahoo.com. And I explained that at the beginning, so watch the video and I'll explain you the blue horseshoe thing. Anyway, have a wonderful holiday. Be safe. Be well. Hopefully you'll be profitable. Spend Black Friday morning trading the futures or options instead of going in there among the crowds. And if you come Tuesday, glad to see you. We'll talk to you again. And if you want to do that experiment, you can email me, and I'll be glad to have you involved with it. And that being said, I'll sign out here, but I will post the PDF right here in a minute. Thank you, Patricia. I'll post the PDF, but let me go so Morgan can do his thing. And thank you guys for coming, and I'll see if I can answer David's question online here.